You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
John Love, CEO at USCF Investments. The company has just over $2 billion in assets in commodity-focused exchange-traded products. John, welcome back to the program. Always great to catch up with you.
Thanks, Ron. Thanks for having me. Really appreciate it.
Contrasting the difference between stocks and commodities, investing great Jim Rogers once quipped that the price of a commodity will never go to zero because when you invest in commodities, you're not buying a piece of paper that says you own an intangible piece of a company that can go bankrupt. Anything you'd like to add to that?
Well, I think that's a great comment. It's true with a caveat, which I'll mention in a second, but it's a great comment because if you look back through history, there's lots of examples of situations where people have used commodities as collateral for something because of that very fact that unlike a company, there is intrinsic value in stuff. So one perfect example is Revolutionary War bonds. The Continental Congress could not pay the soldiers in cash, or at least in a reliable cash, because inflation was so high during the Revolutionary War. So they used Revolutionary War bonds tied to the price of a basket of commodities. So it's a pretty interesting thing when you look at modern commodity markets, and you look back through history and see things like that where that was going on. I did say there's a caveat, and the one thing that investors need to watch out for is usually when people talk about investing in commodities, they're talking about futures. And if you're holding a single commodity and you're rolling it forward, there's an impact from that roll that can be positive or negative. So while the commodity might not deteriorate to zero, the spot price won't deteriorate to zero, the underlying can lose some value over time relative to the spot value of the commodity. So that's something that investors do want to look for.
There are certain seasonal patterns that we look at that tend to repeat themselves more often than not. And one of those patterns is the boost in natural gas prices that typically happens in winter months as people turn on the heat. Talk about that. And, of course, we've got ticker symbol UNG and UNL, both linked to natural gas. Tell us more.
Sure. So natural gas, right now, just for example, we're in something called the shoulder season, which is where we approach the peak amount of natural gas in inventory for the year. And it starts to, what happens is natural gas producers build up inventories over the spring and fall months. And if you look at inventories over the year from January to February, it kind of looks like an S leaning forward. And so we're rising towards peak inventory right now. And then as it gets cold, people start using more and more natural gas and drawing down those inventories. So what tends to happen is if we've had a very hot summer or even a previously very cold winter, we can often go into the new winter season with a low amount of natural gas in storage. Conversely, we can also go into winter with a high amount of gas in storage. Right now, we're about even with the 5-year average. There's 3.6 trillion cubic feet of natural gas in storage in the United States, which is just very, very slightly above the 5-year average. It is higher than last year, though. So what you kind of want to look for with that seasonal factor is as we have, let's say, a fairly standard amount of natural gas in storage right now, do we have weather surprises relative to what's expected? Is it a cold winter? And if that happens, if you get a sudden unexpected forecast for extra blizzards or things like that, polar vortexes, then you'll probably see natural gas prices rising very rapidly.
Yeah, and one thing for sure that we've been seeing more and more of are extremes in weather and patterns, whether that's too hot or too cold. So that's something certainly to watch for. If you're just joining us, we're pleased to have with us John Love, CEO at USCF Investments. Go to uscfinvestments.com. Let's talk about the United States gasoline fund, ticker symbol UGA, which has gained over 34% year to date and is among the top performing commodity ETPs in your lineup. So what's behind the big move in gasoline, and can it be sustained?
One is during this time last year, from October to December, energy prices took a dramatic dip down on, really just trade-related concerns and general economic concerns. So along with equities and really a lot of asset classes, there was a lot of deterioration in lots of market indices, gasoline and crude oil among them. So I think it overshot, and from the start of the year, there was really strong momentum in all the energies, gasoline, heating oil, petroleum. And in fact, gasoline peaked up about 44%, and so we're down a little bit from that peak that occurred in April. As of about noon today, I think we were up 35.5% in UGA. So it's come down a little bit from the peak, which is I think just a matter of the market overcorrected. And first half of the year, it fixed that correction, maybe shot a little bit to the upside. And then some of the fears about trade wars, deteriorating fundamentals, economic fundamentals around the world, and all of that kind of crept back in and then been weighing on the price. So is it sustainable? I think that, we've seen a couple of things this week that suggest that maybe we're nearing the bottom of the current economic doldrums. Maybe a couple positive signs from manufacturing here and in Germany and things like that. Forecasts for crude oil demand, gasoline demand have been going down for this year, but they're still somewhat haven't been moved for 2020. So we'll just have to see. I think it really matters. Do economic signals improve, and do we actually meet that demand? Or do we continue to have lowering fundamentals? If we enter a recession, then that might be a bit of a concern for energy prices in the near term.
Go to USCFinvestments.com. We're pleased to have with us John Love, CEO of USCF Investments. Now, I want to get your take on commission-free ETF trades on major platforms like Charles Schwab and Fidelity and others. I think it's a huge win for investors. It's something that we've celebrated, but not just from a cost savings perspective, but also the once limited menu of ETFs eligible for commission-free ETF trades has now been expanded. So what other benefits do you see from commission-free ETF trading?
So obviously, lowering your cost of trading is always a positive thing, and commission-free lowers the obvious cost of trading, which is Charles Schwab previously, I think it was $4.99, and some of the other brokerages were $8.99. So you can actually get in and out of ETFs easier than you could before without incurring that commission. I think, though, the one thing people should look at, there's two things people should have a little caution about. One is that low fees going to no fees encourages maybe more trading. So if you are a trader, if you're somebody who trades on you know what you're doing and you're trading on a frequent basis, then this is a great thing. If you're an investor who holds positions long but may be susceptible to panicking a little and selling before you should, or buying on a whim, that low fees can kind of encourage you to do that. So you want to use a little caution. The other caution is that while low commissions are great, some of there's other implicit costs in trading ETFs and stocks, for that matter, which is the bid-ask spread and other things. So I think you just want to keep an eye on those factors and make sure you're getting a fair price when you buy any product. But overall, like you said, Ron, I think it's a great thing for investors when things get cheaper.
Agreed. And we're going to have to leave it there. You just heard from John Love, CEO at USCF Investments. And for all things commodities, go to USCFinvestments.com. I'm Ron DeLegge. This is the Index Investing Show. More just ahead. Be here.